In this video, I'll be talking about how a mortgage works, what a mortgage is, the different types of mortgages, the different ways to pay off your mortgage, and the key concepts that you need to understand in the context of a mortgage. I should have started by saying this is not financial advice, and if you're here for financial advice, do not listen to me. If you're here for information, you're welcome to stay. Hi and welcome to the channel. My name is Tosin Ibitoye. I'm a property investor and my partner and I, over the last 2 years, have grown our property portfolio to over £1 million. And on this channel, we document our journey to financial freedom through property investing. What is a mortgage? Simply put, a mortgage is a loan on a house to buy a house. In other words, a mortgage is the money that you borrow against a house in order to help you buy a house, oftentimes the same house. And now, to put a bit more meat on the bone, a mortgage agreement is between you and a lender, where the lender lends you money to buy a house and you agree to periodically, regularly pay towards that mortgage, meaning you're paying to offset what you owe. And once you've made all payments in the term agreed, you fully own the property without any charge. It's worth mentioning that the agreement between yourself and the lender gives the lender the right to take ownership of the property if you default on your repayments. So, how does a mortgage work? So let's say you have your eyes on this property that costs £200,000 and you do not have the total amount of money to buy this property. Then you would approach a lender, which oftentimes can be a bank or a lending company. So you approach the lender to give you money towards the property that you want to buy. Oftentimes, the lender would ask for you to bring a lump sum towards the purchase, which is called the deposit. And then the lender would give you the balance to complete the total amount required to purchase the property, obviously, for you to pay the seller. So arbitrarily, the house costs £200,000 and you have £20,000. So the lender will provide you with the £180,000. So the £20,000 in there is the deposit. You can call this deposit skin in the game. The lender wants to see that you have something invested in this purchase. This balance provided by the lender for the purchase of your property and interest is what is regarded as a mortgage. A mortgage can be and oftentimes is repaid monthly over an agreed period of time. This can range from 6 months to 40 years, but the average amount of term time for a mortgage is 25 years to 30 years. In this time, you own the property, but the lender has a charge on that property, meaning that if you do not fully make payments or if you default on payment at any point in time within your term period, the lender has the right to take the property off of you, to sell it and recoup their money. The regular payments that you make towards your mortgage to offset what you owe the lender is called mortgage payments. And typically, or generally, there are two ways to do this. They are called repayment and interest only. Or you can simply say repayment mortgage or interest only mortgages. A repayment mortgage is one where the mortgage payments you make every single month or the mortgage payments you make regularly is split between the principal that you borrowed from the lender and the interest charged on what you borrowed from the lender. So, for example, you pay back £1,000 every single month for the mortgage that you've taken out on your house. Say 600 of that can go towards the principal. So, if you remember correctly, the house cost us £200,000. You deposited £20,000, and the lender lent you. The lender lent you £180,000. So 600 of your £1,000 monthly mortgage payments will go towards the £180,000, and then the £400 of your monthly mortgage payments will go towards the interest charged on the £180,000 that was lent to you by the lender. This is a repayment mortgage. Now, interest only, as the name implies, you will be paying just the interest that you owe on the money that you borrowed. So the house cost £200,000, you deposited £20,000, you borrowed £180,000, and over the term period of, say, you agreed 30 years, the lender will charge you an interest on the £180,000 for that period. So your mortgage payments now, if it's an interest only payment, will be towards just the interest charged on the money that you borrowed. So you're paying a monthly payment of £1,000. £1,000 will go towards the interest charged on the £180,000 that you borrowed. And I should also add that with interest only mortgages, at the end of your term period, if you agreed a 30-year period, you do not own the property, as you will still owe the total of £180,000 that you borrowed, because in the meantime, you have only paid towards the interest on the £180,000. There are several types of mortgages, but I'll be mentioning just the four important mortgages that there are out there. First, you have, no pun intended, first-time buyers mortgages, and then you have buy-to-let mortgages, home movers mortgages, and you have remortgages. With a lot of these mortgages, the proof is in the pudding. I think what I'm trying to say is the name implies what they are. I don't know why I just said proof is in the pudding. I don't even know what that means. First-time buyer mortgages. A first-time buyer mortgage is one specifically designed for individuals who are buying their very first property. It often includes special features or incentives that help first-time buyers who might not have as much experience or savings to get on the property ladder. A few of the features that make first-time buyer mortgages unique are lower deposits, lenient eligibility criteria, higher loan to value, and longer mortgage term. Home mover mortgage. A home mover mortgage is specifically designed for homeowners who already have a property and are now trying to buy a new property. So they are in the process of selling off one property to purchase another property. So basically, a home mover's mortgage is a mortgage that is being transferred or ported from one property to another property, and one property being one property that you own to one that you are buying. Or you can just simply say a home mover's mortgage is a portable or transferable mortgage from an existing property that you own to a property that you want to move into. A remortgage. As the name implies, a remortgage is when you take out a new mortgage on a property that already has a mortgage. So in this case, you are taking out a new loan to pay off the old loan. So when you remortgage, you can take out a new loan from your existing lender or go with another lending company entirely. Many people remortgage because they want to get better rates or change their interest rate type, or they want to just free up equity in their property, or they want to increase or decrease their monthly payments. Buy-to-let mortgages. A buy-to-let mortgage is one that is specifically designed for individuals who want to buy a property as an investment and rent it out to tenants as against living in them by themselves. Buy-to-let mortgages have distinct terms compared to the standard residential mortgages as a result of different risks that are involved with rental properties. Some of the characteristics of a buy-to-let mortgage include the affordability of the mortgage is assessed against the rental income of the property and sometimes against the personal income of the individual taking out the buy-to-let mortgage. They oftentimes would have higher interest rates than your standard residential mortgage. Buy-to-let mortgages are interest-only repayment mortgages, and a higher deposit is required for a buy-to-let mortgage. Now, I'm sure you're thinking, how much deposit do I need for a mortgage? This depends on how much of a risk the lender sees you as. Typically, the more of a risk you are seen as, the more deposit is required of you. When you apply for a mortgage with your lender, they will usually look at things like your credit history to assess your credit behavior. They will look at your income and expenditure to assess your affordability and whether you have enough disposable income to keep up with your monthly payments. They would also look at your financial commitments, such as your credit card payments or other loans that you have to repay. It's worth mentioning that the size of your deposit also affects your monthly repayment. So the higher deposit you put down, the lower the monthly payments you will pay over time. Now to talk about key concepts that you need to understand when talking about mortgages. The deposit. The deposit is the upfront payment made by the buyer when purchasing a property. It usually ranges from 5 to 20% of the value of the property, with the mortgage covering the remainder of the value of the house after the upfront payment is made. Credit history. This is a record of a person's past behavior with credit. So a lender will typically want to see how you have managed your credit cards, your loans, or previous mortgages, whether or not you kept up with payments or if you defaulted. So this record is your credit history. Affordability. Affordability is a lender's assessment of how much you can borrow depending on your income, your expenses, and your other financial commitments. I should add that as a general rule, if you want a quick maths calculation of your affordability, it's a 4.5 multiplier times your salary. So if you were making £20,000, you multiply that by 4.5, which means 4.5 times £20,000 is £90,000. That means you can borrow £90,000, meaning you can buy a house of 100,000 as long as you have a deposit of 10,000, you can borrow £90,000. Remortgage. A remortgage is simply switching your mortgage to a new mortgage deal, whether with your existing lender or with a new lender. Usually, many people do this for better terms, better interest rates, or decreased or increased monthly payments, or simply to free up equity from your property. Refinance. A refinance simply is a remortgage. So these two terminologies can be used interchangeably. So this simply is switching your current mortgage to a new mortgage, whether for better rates, better terms, freeing up equity. It can be with the existing lender that you have or with a new lender entirely. Interest. Interest is the cost of borrowing money from a lender, and it is charged as a percentage of the loan. Agreement in principle or decision in principle. This simply is a provisional offer made by the lender to yourself, indicating how much they might be willing to lend you considering the initial assessment of your financial commitments and credit history. Fixed rate. A fixed rate mortgage is one that has a constant interest rate for a set period of time. Variable rate. A variable rate mortgage is one that has an interest rate that can change over time, usually in response to the movement of the base rate set by the central bank. APR, annual percentage rate. The APR is the total cost of borrowing on a yearly basis, including both the interest rate and the additional fees. And that's it. I believe that is everything you need to know as a beginner dealing with mortgages. And I'll leave you until the next one.